Welcome aboard here. I am Marziti, and we're going to talk about long-term holdings today. Let's see what we can get into here, some mischief we can get into. We'll start with a disclaimer, of course. This presentation was created by me, Marziti. I am not a financial advisor. This video is for educational purposes only. I am only a member of the Bullish Bears community. I am not compensated to do this video in any way. Information presented here does not necessarily represent the opinions of the Bullish Bears communities. You are responsible for your own trades, and you may copy and redistribute this video as much as you like, so long as credit is given to the author, and that would be me. Also today, we're going to be looking at a website called stockrover.com. And they have granted us permission to demonstrate their website during this presentation. And so I will be talking quite a bit about them as we go through this. Well, at some point, of course. At any rate, considerations about long-term holdings. The first thing you have to remember is that long-term holdings, we think of it from the viewpoint of an investor. Now, why do I say that? Well, because most of us think of things from the viewpoint as a trader. Most of us day trade or swing trade, and we're in and out of positions within the day, within the week, within the month, or whatever. But long-term holdings, we are going to hold through the good times and the bad times, as long as we think it can return to good times. And we're typically going to hold well more than 365 days. This is a completely different way to think about things. And so you've got to train yourself or remind yourself, or whatever it may be, to think about the fact that you're going to sit on this stock or this ETF or whatever for around 365 days. Now, let's see. Let me get my little pointer thingy up here. So what we're after here is long-term gains or long-term capital gains. When we hold a stock, ETF, bond, or whatever for more than 365 days, and then we cash it out, sell it, whatever, that will be taxed at long-term capital gains, which for most people should be less than short-term capital gains, aka ordinary income. So there's typically less tax owed on the long-term capital gains, and that's only if you hold it for a minimum of 365 days. So we typically want to do that. Pardon me, we're having a little bit of the pollen this year here, and I've got a little bit of a runny nose kind of thing, so if you hear me pause for a moment, it's probably because I'm clearing my throat. At any rate, long-term holdings often have some degree of dividends, which is always nice. They can range from a lot to a little. We'll talk a lot about dividends towards the end of the presentation. We have to be willing to hold our holdings even during the pullbacks. That is what an investor does as opposed to a trader. We're going to hold during those pullbacks, and we're going to look for opportunities to dollar cost average. Now, what is dollar cost averaging? Let's see. Let me click my mouse thingy here so I can go to the next slide. Dollar cost averaging is buying shares based on either pullbacks or by schedule. Now, excuse me. If you've worked a job where you've participated in the 401k program, you have already been exposed to dollar cost averaging. Pardon. And that is because with every paycheck, a small portion of your paycheck, or whatever whatever you set up, a portion of your paycheck is extracted and sent into your retirement savings called a 401k. Now, they are going to invest that straight into the market regardless of whether the market is up or down or sideways or whatever. They do it by calendar. And the good and the bad to it, the good side to doing it by calendar, of course, is that you're going to constantly be putting money into the system as opposed to a buy it and forget about it kind of thing. We don't want to do that. We actually want to be putting money into our long-term holdings when conditions are right. The downside to it is, though, with the 401k is since they don't necessarily wait for pullbacks or anything like that, it goes in, the market could be at the peak of the peak of the peaks, and they're still going to put it in. But there are those of us that end up taking control of our retirement monies. And you can do this a lot of times too, even with your 401s in some cases, if you talk to the administrator of the 401 trust there and ask them how much discretionary control you have over it. Now, what we're looking for is typically a pullback. And there are different criteria for these kind of pullbacks. Let's talk about that next as we'll go to the next slide. Here we are. SMA crossovers. Now, this is not moving averages crossing over. This is price crossing a moving average. And I want to clarify that. That may not be the best choice of words there. But so let's talk about that for a second, though. If the price closes below the 50-day, we would buy some more shares. If it crosses below the 100, we would buy some more shares. 200, buy some more shares. Now that's using the simple moving average strategy. Alternatively, we can look at using standard deviations. I personally use a 252-day linear regression with standard deviations based on that. So you could say perhaps when the stock closes below 1 deviation or a half deviation even, 2 deviations, that would be another thing. And the third, of course, approach here that we could consider might be technical analysis. The key is this should be mechanical. When something triggers, boom, it closed below the 200, you buy shares. You should know how many you're going to buy, and you have a system that says when this happens, I buy. When that happens, I buy. How much do you buy? You should already have that worked out. So this should be totally 100% mechanical. Regardless of how you do it, use the same system and do it when it triggers, you do it. That's what we do. So let's see. Excuse me. Let's move now. So how do we do this? The idea, why do we do it? Let's go with that. We do it because we're looking to lower our cost basis in a holding. Now, what does that mean, cost basis? All right. Now, let's say that we buy 10 shares of a stock. The Acme Widgets Corporation sells for $100 a share. Let's say that we buy 10 shares of Acme Widgets at $100. We spent $1,000. Our cost basis is $100 per share because we paid $100 per share. Well, let's say that Acme Widgets pulls back to $90. And we say, woohoo! We go in there and we buy 10 shares. We have 20 shares, half of them that were at $100 a share, half of them were at $90 a share. Our cost basis, therefore, is the average of all that, which would be $95 a share. We're trying to lower that cost basis as often as we can. And that's why we use these pullback strategies with dollar cost averaging to make that happen. Oops, jumped too far. Now, it is important to understand that you've got to have money. You've got to have cash. Meaning that once you get into a stock or an ETF, you got to have money there for when it does its pullback or whatever your dollar cost strategy is, that you can buy some more stock. So we are looking not to go in 100% unless you got, it depends on two things. One, if you've got a fixed amount of money, say you have $10,000. Okay, you got $10,000 and we're going to have five ETFs. We're going to focus on 5 ETFs. Well, that means that you're going to put $2,000 in each one of them. But you're not going to put $2,000 up front necessarily in all of them. Maybe you only put $1,000 in each of them, and then when they have a pullback, you might put an additional $250, $300, $400, whatever. so that you've got some cash on hand that when the price pulls back and triggers a dollar cost averaging trigger, you've got cash to go in and buy it. Now, on the other hand, you may have extra money with your job. So, perhaps you've got an extra $200, $300, $400 extra every month that you can allocate. And so you can say, okay, I can go ahead and buy all my $10,000 worth of this stock or these stocks or ETFs or whatever, because I still have every month a little bit extra money coming in that when the dollar cost averaging happens, I've got it that I can do it. So either way is fine. The point being, though, is you've got to make allowance that you've got cash somewhere, somehow, so that when a dollar cost average strategy trigger happens, you can go in and buy shares. So, okay. Let's talk about an example here. In fact, you know what? I'm going to scratch this slide. I actually had prepared a couple other slides. Let's take a look at this one here. I actually hold this. This is actually, and these are my trades on here. This is SPYI. This is a dividender. It pays, I bought it because it pays good dividends and stuff like that. This yellow line right here represents when I got in, the date that I got into the stock, which was on April the 11th, it looks like. And at that time, my cost on that stock was about right, if I look to the right, looks like it was around $49.75, okay? Well, lo and behold, now, it's important to understand, I knew, the background story to this is I used to farm out my long-term holdings, but there was a background story, blah, blah, blah. I'm happy to share it, but not, for sake of time, I'm going to spare doing it here. Anyway, I ended up having to take total control of my long-term savings as far as managing them and everything like that. So fine. The problem was when I got into all of this here, when, I had the money, but I had a problem. And those of you, if you're looking at this, and this is in April of 2024, you know that that a couple weeks ago we were running higher highs on the SPY, on the Qs, on everything else. And I mean, man, it was just, what we all knew a pullback was coming. We all knew a pullback was coming. We just didn't know when. And I had this cash, my retirement cash here, and I thought, I could wait till we have a pullback. But when would that pullback be? It could be 3 months, 6 months, could be a year. I didn't know. And on the other hand, I'm like, well, I don't want to put everything into the market because if we have that pullback, I won't have any money left over to dollar cost average or anything. So what did I do? I put 10%. This position right here was intended for I was planning on putting $5,000 into SPYI. So how much did I do? I bought $1,000 right here. Bought $1,000 right here. Wouldn't you believe it? The very next day, you know what this blue line is? It's my 50-day moving average. The very next day, we closed below my 50-day moving average. Now, I used the moving average strategy. What did I do? I immediately bought another slice of $500. So I had $1,000 up here. That was 10% of my entry, or 20% rather. And then I bought $500 worth of stock. Whatever the stock, however much stock I could get for $500, that's what I got. And then wouldn't you know, the very next day, it broke this green line. Well, that's my 100-day moving average. I'm like, you're kidding me. But the pullback had begun. How much stock did I buy? $500. So now I'm in for $2,000. Okay? Remember, I was planning on $5,000 in here, so I'm 2/5 all the way into this trade. And then wouldn't you know, 2 days later, it crossed my 200 moving day average. What did I do? I bought $500 worth of stock. Now again, like I said, notice this yellow line here is my cost. So we started out here around $49.75. Then my next trade brought it down to 49.60, then down to around 49.47, and then down to 49.31. So I am now essentially halfway into my position here. I've got $2,500 into this out of my planned initial $5,000, and I've already managed to bring my cost down. It's not. We're not. You're not going to take this to the bank necessarily, but remember, I have been buying shares and shares and shares. And the other thing to remember too is that every time this price drops and I buy more, I end up, because I'm spending a fixed amount of money, $500. In many cases, I'm actually able to buy one or two more extra shares because the share price has come down. I'm able to actually buy a few more shares. So that's using the moving average strategy. Here I had bought it here once, and I bought it here again, and I bought it here a third time. Okay. Now, what about, let's take a look at, what if you did it based on the exact same chart, based on linear regression? Like I said, I use a 252 linear regression line here, this white line. This red line is a one half deviation. Green is a full deviation. Blue is a 2 deviation. Well, let's take a notice here. I want to notice that right around in here, and let me get out my marker so we can see this. Let's kind of note that right around in here, the price had stayed above this half deviation plus half deviation line. It stayed above it and above it and above it and above it and above it. Now, where did I get in? Well, actually, this is the exact same stock. It's just with a different trading strategy. I got in right there. Right there. Okay. There's you can see my yellow line. Let's zoom in on that. Shoot. Get my arrow. Try that again. And let's drag. Really? Move. And let's drag this over so we can see it. All right. There's where I got in, right there. Here, now it's been trading above this half deviation line. Here, it closed below that deviation line. I would have bought here. Here is return to median, 0. I would have bought here. Here, here. It would have closed a negative half. I would have bought there. So there's 3 different points where I would have bought if I were doing linear regression for my triggers on dollar cost averaging instead of moving averages. As you can see, in the end, actually, it worked out to be the same. So I bought in 3 times, and in either scenario, I'd be in for $2,500. So there's 1 and there's 2. Now, so that's what this chart was originally about, but it was easier, I thought, to show you on the other chart. Okay, what else is there to dollar cost averaging? Every time we get a dollar cost average opportunity, we want to take advantage of it and buy some stock or whatever kind of thing. And we're going to do this for years and years and years and years. I want to point out to you that long-term holdings is not something that you just set it up and walk away from it and come back to it in 20 years. It's not that at all. This is not, this is a situation where you are kind of active in it, but not very active necessarily. You have to understand, we hope that as the markets go up, you will get the effect of price appreciation, that a $100 stock will go to 105, then 110, then 120, and 20 years from now, it'll be $1 gazillion, and we'll all be happy. But at the same time, we need to throw additional capital at it every chance we get to accelerate the overall growth. So that's why we're going to use that dollar cost averaging and to get it up to speed and then to take it beyond that point. And, maybe you're on a tight budget. Maybe, in my opinion, it's just my opinion, you should consider your dollar cost averaging to be one of your monthly bills. What I mean, or weekly bills. I mean, you got your electric bill, you've got your car payment, your house payment, and then you got your dollar cost averaging payment. If you can make that part of one of your weekly or monthly monetary expectations, I got to do this every month with my money before I go out and eat and spend, all that money at the restaurant. I got to set aside money for my dollar cost averaging. Even if all you can do is one share at a time, this will benefit you in the long term. This will benefit you in the long term. So what else have we got then? Well, so we're going to set up a portfolio with maybe a dozen stocks or bonds or ETFs or whatever it is we're using. I personally like ETFs because they're diversified. You don't have to worry about the bizarre craziness of earnings so much and all that kind of stuff. I like ETFs personally. That's just me. But some people really like to zero in just on their stocks. And I went, whatever. They really prefer to zero in just on stocks. And that's fine. Perfectly fine. Everybody's got their preferences. Just remember that stocks can be more volatile. ETFs kind of smooth it out a little bit. So let's just hypothetically say, again, we come back and we talked about we had $10,000 and maybe we're going to pick 5 ETFs. All right. Now, and we've been dollar cost averaging in faithfully, and let's say that we've got 9 out of $10,000 invested amongst these 5. They're all near or very close to $2,000 a piece. Okay, now what? Well, at this time, since we're real close to 100%, we can either maybe we want to add a 6th or 7th ETF or stock or bond or whatever. Maybe we want to move away from just 5 holdings to 6 or 7 or 8 or 10 and start spreading it wider. Or we can go deeper by saying, okay, we're at $2,000 on this ETF. Let's move its next target to $3,000 or $4,000 or whatever. So you can go wider or you can go deeper. The point being is you don't forget about it. Every month you need to go in there and do something with it. Add to it, add to it, add to it. That's what we really want to do with these long-term holdings. Now, what should go into a portfolio? Well, we've got a variety of different things we can consider. First of all, there are major sectors. Now, like the S&P 500 is divided up into, it has 11 categories, and then there's a 12th one that's not part of the S&P. So let's take a look at that. You have your communications like AT&T, Verizon, T-Mobile, okay. I'm not exactly sure where Cisco fits into this, but they're either communication or tech. I'm not sure. But at any rate, you have companies that are classified as communications. Discretionary is stuff that you spend your own money on that you might choose. For example, what car you want to buy. Tesla is consumer discretionary. So that's, companies that make stereo equipment, whatever, that kind of thing. That's discretionary. Energy is not necessarily your power company. The energies we're talking about here are solar, gas, oil, things like that, wind and so forth like that. Now, they may also be your energy provider, but most of our energy providers are actually under utilities. All right, so we got financial, healthcare, industrial, materials, real estate. I'll explain the star in a second. Consumer staples. I don't care whether there's a war going on or it's peacetime. If the markets are up or if the markets are down, you're going to buy toilet paper, toothpaste. You're going to buy your daily essentials, and we call these consumer staples. And so there's a category for just that. Now, to be honest, staples are not exciting, but by the same token, when tech goes up and tech goes down and tech goes up and tech goes down, staples is typically pretty smooth sailing the entire time. So, okay. Let me come into this mention about real estate real quick before I go to alternative. Real estate has a category called REIT, Real Estate Investment Trust. And the only reason I put a star here is because the way the taxes are handled on REITs, as we call them, is different. Taxes on them are a little bit more complicated. Now, if you got an accountant, it's not your problem. Your accountant may tack on an extra hour to his or her bill. But just realize that, especially if you're doing your own taxes and stuff like that, that REITs will be a little bit more complicated. And so you need to decide whether you're going to get involved in REITs or not. Alternatives. We have a lot of alternatives out there now. We have Bitcoin. There are quite a few ETFs and stocks that are based on Bitcoin and other kinds of cryptos. And then, of course, there are option-based ETFs. For example, JEPQ is they buy the NASDAQ 100, the NQ, and then they immediately start selling covered calls against it. And as a package deal. And so they go into the alternative category because they really don't have anything else going on here. Bitcoin, like I say, there's stocks that are based on Bitcoin, like Mara and MicroStrategy. And then you've got ETFs like FBTC, IBIT, and different things like that that are based on crypto. All right. So first of all, we want diversity because diversity, as I said, as tech goes up and down, staples are smooth going. And it just depends on what's going on in the world. One of these sectors is always hotter than the other. And so we want to be diverse to kind of capture that. We want to ensure that any stock or ETF that we get into has a good, solid history. We want to look at the 5-year, the 3-year, the 1-year history of it, maybe even the 10-year, to see how's the stock doing. Is it growing? Is it growing? Is it falling? What's it doing? I personally have always been a strong advocate to make sure that it has daily volume. I like to see 1 million shares volume in it because that tells me there's a lot of interest. It also means that I can get in and out of positions quickly with it if I need to for whatever reason. I like a market cap personally of $1 billion or more. That tells me this company's got enough money to attract talent to run it. And then finally, some companies offer dividends, which I'm going to talk about a little bit more about that here in the next slide. So again, though, but the point being, history, volume, market cap, and diversity. All these are very important, and we're going to look at that when we go to the website and start scanning for some of this kind of stuff. All right, so let's talk for a moment here about growth, value, and dividends. Growth means that the stock price goes up pretty fast, but little to zero in dividends, like NVIDIA, AMD, Netflix, our Mag 7s. They pay, if most of them pay no dividends. I think Meta just introduced dividends, but it's not a great dividend, but they did just introduce one. You don't buy these for the dividends. You buy this because the price of the stock is going up, 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 up. Now, what do you do with it in 20 years? Well, you're going to sell that stock and take that money, and you're going to buy value stocks or dividenders below it, but predominantly value stocks. So a value stock is the price goes up very slowly, but it pays dividends. These are very stable companies usually. We're talking about our Ford, General Electrics, General Motors, our staples companies and things like that. When we talked about consumer staples like the toothpaste companies and all that, Procter and Gamble. Like Ford here pays, I think, about a 4% dividend. Now, that's not a great, tremendous amount of money. But as we're younger and things like that, we want to get our stock values up, and then we're going to cash them out and move them into value so that we can hopefully retire on our dividends. And you say, well, okay, why would you do that? Well, if, for example, you have children or some charity or something like that you want to leave something to when you die, see, if you if you just cash out your growth stocks and you live off your growth stocks, just cash a little bit of, 2 or 3 shares every month and live great off of it, well, there's nothing left to pass on, or very little to pass on. But if you moved everything into value, you've got something that you can pass on to, whomever, whatever. Dividend price, there are stocks and ETFs that are specifically designed just for dividends, like JEPQ. And I promise you, I've got a big topic. That's a big topic coming up here in just a minute. So, let's see. By the way, these dividend stocks, they may go up, they may not. I'm going to give you a very, very, very strong warning right now about high dividend stocks that there's a surge. About a year ago, like I said, this is the year 2024. About a year ago, there was just a bunch of ETFs that just hit the market. They're talking about super duper high dividend yielding ETFs here. Man, these things pay 15, 20%. Oh, these things are outstanding. And you have to look for what's called a dividend trap. Now, I want to focus for just a very quick moment, and we're about done here before we go to the chart, but I want to focus on this word return. Return is not price appreciation. Return is not price. Return means price plus dividend. Well, now, so the formula is the 1-year return minus the dividend better be greater than 0. Because if it's not, it means the price dropped, but the dividend was so high nobody noticed it. You don't believe me? I'm going to show you right here a real example. Step right up here, folks. Step right up here. 12% dividend yield. You heard right. It's 12% dividend yield. 1-year return of 2.2%, folks. Monthly payouts. Tickets are only $16. Get yours today. This is a real stock chart of a real, and I didn't give the name. I don't want to shame them. I'll be glad to show anybody who wants to see it in private. This is a real stock chart of a high-yielding dividender that does, in fact, claims to pay 12% and does. There's historical records. It pays 12% a year. They divide it out in monthly payments and all that. This is its stock price over the last 3 years. Where is it going to go? 0. Why? Because they're paying out more in dividend than the stock is growing. Where do you think, therefore, that dividend money comes from? Me and you, the investors. We give them $1, and let's say that they made a 3% dividend. They tell us they made 5%, though. So they give us 5 cents back. What we didn't realize is that they took 2 to 3 cents from the $1 we gave them in the first place and just gave it right back to us and called it a dividend. Well, if they call it a dividend, guess what that also means? You got to pay tax on that. You got to pay tax on your own $1 that you gave them. Does that sound like a great deal? Not to me. So look at the chart. This is a 3-year chart. You just go, if you think about one of these dividends, now there are some very legitimate, very, very legitimate, high-yielding dividend stock and ETFs. Go look at the chart. All right, that's all I'm going to do with that. We're done with the presentation here. Now, what we're going to do is we are going to go to Stock Rover. Now, the good folks at Stock Rover gave me permission to demonstrate a little bit, to use their website during this presentation. And I want you to know, now let me just kind of mention, what is Stock Rover? Stock Rover is I use them for screening for stocks, ETFs, stuff like that. There are services like Morningstar, Seeking Alpha, and Stock Rover. What makes Stock Rover unique is if you are a data spreadsheet junkie like I am, then Stock Rover is right up your alley. If you like detailed data, Stock Rover is right up your alley. You're going to love it. Now, if you hate all that fine detail kind of stuff, then, you might go look at Seeking Alpha, Morningstar, something like that. But StockRover is just awesome. And I no affiliate links here. That's a personal recommendation. I am simply a yearly paying member of them. I want to. They have portfolios, watch list, and screeners. I'm going to focus mostly on the screeners. Let's take a look at that for a minute here. So over in the screeners, oh yeah, I need to save that. All right. Whatever. Hang on. Let me get. I thought I had this set up. I obviously didn't. Here are my screeners on the left-hand side. Let me get over to here. I'm going to go to, now personally I like ETFs, so I'm going to do ETFs. I'm going to take my master ETFs sheet here. I'm going to go to modify right down here. And I'm going to zoom in on some of this because I know you can't see it. Just bear with me a moment here. Now, as a matter of fact, let's go ahead and do that now. Windows Plus. There we are. One more. There we are. You can put all kinds of things into StockRover's screeners it's got all kinds of stuff. Now, the only thing that StockRover lacks, I wish that they had, was information about options. They don't have anything in here about options, but okay, it's all about stocks, ETFs, and that kind of thing. So let's say that I want to look at a stock that cost me less than $250. You can search based on price to earnings, monthly returns, yearly returns. They even have a 5-day return. One of the short-term trading strategies I have is called running the dogs, where we're looking for the short-term runners for short-term price boost, and I use the 5-day return to screen out and look for the dogs, if you will. Maximum drawdown, how far back is it pulled back within the last 5 years? You can also do that on the 3-year and the 1 year. I just don't have it here. Here's that formula I put in there that the 1-year return, remember that return is price appreciation or depreciation plus the yield. So I take the return and I subtract the yield out of it, must be greater than 0, telling me that the stock itself actually did go up in addition to the regardless of the dividend. You can screen for the 12 trailing months, or trailing 12 months, I should say, trailing 12 months. That's the historical last year yield. Dividend yield is the projected forward yield for this year. You can scan for things like, well, did the dividends increase this year over last year? What's the average 3-year dividend, 5-year? Market cap, I did say here that I liked $1 billion minimum. So I'm going to put that in. And I did say that I'd like to see volume. We're going to put in 100,000. Must be at least 100,000 shares a day traded. Now, let's see. There are 295 stocks, or ETFs rather, 295 ETFs that meet my criteria. Now, there's one other thing here. I've got this category group. You see all this here. And what that is, and I want to show this here, I'm in the United States. It is my understanding, I could be wrong, I am not an accountant, but if you make money in other countries, there's a double tax possible situation, and I just as soon avoid that. I don't want to get anywhere close to a double tax situation, so I just turn Canadian off. No offense to our good friends up there north. You can turn the U.S. off all you want to. All right. Now, let me zoom back out. Actually, let me just see. Can I get? Yeah, okay. Now, this is just this is just the A, B, C's of the list. Obviously, this is not the entire list. I'm not saying anything here. All right, let me zoom back out so I can get to the regular screen. What I'm going to do down here in the bottom right-hand corner, I've set all this criteria up here. There's still 100, and there's 295 of them. We did talk about we need to see some strong returns, so let's go there. I want to see 8%, let's just say 5% a year. I think inflation really is 8% or 9%, whatever, but I'm going to put in 5. Oops, wrong place. 5 goes here on the 1 year. We'll say 15 here on the 3-year and 25. It's actually more than that, but I'm just making it easy right now. I want to see 25% increase over 5 years. Now, that has whittled our list down to 126, 126 candidates. So let's see. What else can we put in here? Maybe. Now, we could say that we want at least a dividend. It must pay at least a dividend of 1%. That's not a lot. Let's see. 126 goes to... Well, come on. 90 down here. Set it down, put it down here this time. Okay. So 90 out of 5,400 ETFs on the North American Exchange pay at least a dividend of 1%, and that meet all the rest of this criteria here. So let's go take a look at that and just see what that does. Let me back out here. I'm going to save this layout. You have to do that in Stock Rover. You have to say it before you can move on. I'm going to run it in a table. Now, I'll set my cursor right here, Windows Plus, and let's kind of zoom in a little bit. Let's look, first of all, just do we recognize the names? CAF, this is a really fantastic one right here. You may not know it. CAF and Cows. Funny little company, but, cool. DGRO, DGRW, these are dividend companies. Do we recognize? We see quite a few Fidelities in here. Okay, iShares is BlackRock. I believe that's right. And we see they got some dividenders. The Russell Top 200, the Russell Top 1000. All right, so we're just kind of moving along. And I'm just looking to see, here's some uranium. Here we got some Vanguards down here. And then we've got some Spider S&P actual sectors, XLB, EF. Like this here is all financial stuff. This is all industrial. This is all healthcare and so on. And so on. All right. Now, that's great. But that's not, I really don't care. What I want to do at this point is I'm going to go over here. And what I want to see are these categories. Remember that I talked about that we need diversity. So I'm going to click and I'm going to sort by category. There we are. And let's just kind of take a look at, let's get you out of the way. There. So let's just see. These are commodities, broad basket. Derivatives, they probably sell options. This is energy. Then we have financials, sector information, health. There's one industrial, probably pave, I would imagine. Here's infrastructure. Here's large blend. Now, large blend simply means, they've just got big companies everywhere in there. That's all it means. They just got a bunch of big companies in there that are doing well. And now remember, we set a criteria, minimum, everything here, they had to do 100,000 shares a day. They had to be growing 5% last year. They had to be 15% up from where they were 3 years ago and 25% from where they were 5 years ago. So all these companies, all these ETFs here are growing. No question about that. As I scroll down, now we've gone from large blend into a bunch of large values. The thing I want to point out to you is that many of these are going to be almost identical. In other words, if you go look at a large blend here, you're going to see, and let's just do that. Oh, I've got to bring the mouse. Come on, 1 second. There we are. Whoops, too far. Okay, one more time. Slow down, not so fast this time. There. These are all those large blends. And look at them. S&P 100, Russell 1000, S&P 500, Schwab 100, or 1000, large cap, 500, 500, 500. They're all the same. So you want to start screening that down. Maybe you, if it's ETFs, you can maybe screen it down by expense ratio or whatever, but you only need one of these large blends because they're all the same. So what other things could we do possibly to screen some of this down? Well, how about, well, if I can get, hang on. Let me start this back over here. All right, let's go here. Let's sort by return. We see that the return goes from 176 all the way down to 30, with an average being of the very last line's an average here being of 76. You know what I'm going to do? I'm going to cut out everything on the bottom half. Here. And I need to go to the left. Now this is just a quick and dirty kind of thing. And I am going to, because hang on, I can't see the thing. Oh, wait a minute. I haven't put it in a watch list yet. This is a screener output. So what do we got to do here? I made a mistake. I apologize here. Let me go over to actions here. And I am going to save to a watch list. And we're going to call this watch list, which y'all can't see until I back out right there. Bullish bears. Yay, bullish bears. How are we doing on time? 47 minutes. I need to get a move on. All right, now over here on the left-hand side, I'm going to go to watch list, and we're going to go to bullish bears. Now I can actually modify this list. So let's try that again. Now this time I'm looking at the, oops. As you can see, I'm looking at watch lists. And under watch list, I'm looking at bullish bears. And I'm going to come over here to the 5-year return. It's already sorted, but I'm going to do it again. And we saw the average was 76, and we said we're going to cut out everything below 76. So here. Now I'm going to scroll over here. And any one of these here, I can just simply come in here and drop down, and I'm going to remove it from the watch list. Gone. Well, that trimmed our list down quite a bit. We're down now to 89. Let's go look at the 3-year return. The 3-year return says that it is 35. So let's just get rid of everything below, I don't know, 25. I could take out, but I don't want to whack it too terribly much. So let's just take out these. These are the ones that are lower performers on the 3-year. Remove from bullish bears. That now leaves us with 53 rows. Okay, now, could I call it now, trim now based on the 1 year? I could. One of the things I do want to do, though, is I want to make sure I keep as many of these categories that I can. And so I would start sorting by category and then calling out some of these stocks over here so that I only keep the best of large value, the best of large growth, the best of large blend. Another thing that you can also do with Stock Rover is if you just move that for a second, is you can filter to a CSV and import into Excel so that you can do customized sorting and things like that. So I do that all the time, is come under actions and save the table as a CSV file. So that's that's very, very handy. Matter of fact, let's just do that real quick. Save to CSV. Let's open it in Excel. And I'll demonstrate very quickly because we're running a little short on time. But anyway, and let's move this out of the way. Put you over there. So in Excel here, I can come up here. I can come up here and click for everything. And then I can come up to filter. And that puts an individual sort and filter tab on each one. Since everything is highlighted, I'll double click this space between them so they'll properly space themselves out. Okay, so maybe I want to see who's got the best dividend yields or whatever. So, well, no, we were going to, whatever. Anyway, you get the idea of what I'm trying to say here. I could sort by largest dividend yield. We got some pretty good dividenders in here last year. Maybe I want to sort by largest drawdowns because maybe I am a little concerned about getting into an ETF that could draw down 89%, and I'm like, I don't want to go there. Maybe we'll keep, we'll say it's got to be at least no drawdowns more than 50%. So I'll come over here, I'll grab all these, and I just hit delete, and they're gone. We're down to 39. Actually, we're down to 38 because that summary line doesn't need to be there either. See how I'm trimming this? I'm just finding things that are important to me, and I just trim them away in different things. All right, so let's so that's enough using Excel. Then you come down, and so we're looking for again. Let's go back and look at what did we choose in our where we were in a screener. Come here. There we are. Master, modify. Let's go back and look at what I put in here. We said 5% last year growth of the return. Now remember, that's return. That will include the dividend. 3-year return includes the dividend as well, but okay. But we do ensure that the dividend is not greater than the price appreciation itself. We did say we wanted to look for stocks that had at least a 1% dividend. They have to be at least $1 billion company. They have to trade at least 100,000 shares a day, and they are U.S. based because I'm in the U.S. And nothing more than $250. All right, all that criteria here, we've been filtering down this and whittling it and whittling it and whittling it down until we get to maybe, I don't know, how many sectors do we have here on our list? Let me go back. How many did we have? Yeah, okay. Let's just count it out real quick. Small value, there's 1, 2, 3. That's a traded thing, leverage. 4 in value, 5 in growth, 6 in blend, 7 in infrastructure, 8 in industrials, 9, 10, 11 at least. There's 11 ETFs that would help you diversify your entire portfolio. You just got to pick the best one in each one. There you go. It's all done. There's your long-term portfolio that you could start working with. All right, let's get rid of that. What about dividenders? Let's just take a look. If in case you're interested in some of these dividenders, blah, 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 or high growth. Let's see what I've got for high growth. No, that's not exciting. Here's ETF dividenders. Let's take a look. That's on a watch list, so I've already filtered it for different things. But we can see here that what am I looking for? Where's the yield? Well, phooey. I'll have to add that. 1 second. TTM. Yield. Let me see the yield. Where is it? Right here. So here's some ETFs that pay dividends. Here's like IDV. Come on, quit doing that. Here's IDV. Pays a 6.6 dividend last year. The stock appreciated. Well, notice, see that? I hope you're seeing that right there. How much did the stock actually go up? It didn't. It went down because the yield is greater than the return. The stock actually went down. If the 1-year return is 6.2%, but the yield is bigger by 0.4%, then the stock didn't appreciate at all. Did not go up. Stock actually lost value right there on that one. But here we see a 9.3 return minus the 4.6 means that the stock appreciated about 4.5% and still paid a 4.6 dividend. Not bad. Not bad. I hope y'all catch exactly what I just said about IDV. If we go back, that's not a long chart here, but whatever. Anyway, y'all get what I'm saying. Anyway, so there are some decent dividenders you can find in here. You can see the drawdowns. You can see the 10-year returns if they're that old. That's cool. And so on. All right, I'm about ready to wrap this up. So let's just kind of go back and talk about, well, let me get my screen back to normal. And let's just go back, and I want to go too far. There. You want to diversify. You want to find a strong history, a stock or an ETF that has performed well over the last 1 year, 3 year, 5 year, maybe even 10 year. You want to make sure it's got volume so you can trade it. You want to make sure it's got market cap, minimum $1 billion, so that you know that it's a strong enough company. And dividends is totally up to you. You may want to do dividends. You may not care about it, whatever. But so, and of course, ultimately, as I said before, diversify. Now, all this has to do with your long-term kind of stuff, and you simply are going to use the dollar cost averaging to step into it a little bit at a time. When things are favorable, on these pullbacks, buy a little bit, buy a little bit more, buy a little bit more. Folks, I hope you've enjoyed this. I hope you've gotten something out of it. I know it's been a long video. It hadn't been, it's been kind of a dry video. I get that. I appreciate the folks at stockrover.com for allowing us to use their website. It's an interesting site. Like I said, I like it personally. I'm not an affiliate or anything like that. I pay whatever the yearly is to use it, kind of thing. But, if you like spreadsheets and stuff, it's something you could check out. On that note, please join us over at the Bullish Bears. We have a great group over there. Very upfront, honest, straightforward group. Live trading right in front of you. You know if they're telling you the truth or not, because you can actually watch them do it. And all that kind of stuff. You can find out more about that at thebullishbears.com. And with that, I am Marzidi, and I am signing off, and I wish everyone a green trading day. Bye-bye.